I am Mars Director of Research, David Arbit. And I want to start, as we have, by thanking our wonderful sponsors. So I want to say thank you to Bell Bank Mortgage, as well as North Star MLS, RCU Royal Credit Union, used to be Realtors Credit Union. Interesting little trivia there. And our friends at SuperKey, one of the more innovative and forward-thinking lockbox and key providers in the industry. Okay, and with that, now that we've gotten some of those housekeeping items out of the way, let's dive in. First, as we say, we hope this finds you and your loved ones safe and healthy, and hopefully staying sane. And I also want to point out the Mark COVID-19 resource page. You know, we also have additional resources for rebuilding after some of the recent events. We also have some resources for rebuilding, ways to get involved and ways to donate and contribute. So do check that out. And I'll just show you guys really quickly, from our end, the Mar in Your Corner, we've got a lot of important info that we really encourage you guys to check out. Here's something that's near and dear to my heart, our weekly local housing market updates and our weekly webinars. Just in case you're lost, you are here. This is where you are right now at our weekly webinars. Just a little bit of a breakdown. I guess we weren't done with housekeeping items. Just a little bit of a breakdown in how I'd like the next hour to go. We're going to start with talking about the market as we do. That's going to take up the bulk of our time. Depending on timing and questions, and I guess how much I ramble, I also want to take at least 5 or 10 minutes just to walk you guys through some of our market reports and info sparks and how to access both. And then again, depending on timing, I do have a few slides to talk about and give a little bit of an economic update and hopefully a little bit of a recovery update on how we're looking on the recovery. Okay, so this is an old one. I've been showing this for several weeks now. Everything still depends on these three things: the length of the pandemic, the impact of unprecedented levels of stimulus and relief, as we've mentioned, and then, of course, the consumer response, or the reaction, if you will, and how that might drive consumer spending and consumer behavior and things like that. So I have a little visual here in case these are too many words, and sometimes these are too many words for me. So a handy way to think about this, right? We've got the virus kind of on this side of the tug of war pulling this way. We've got our legislators in Congress, our friend Jerome Powell at the Fed, and our very talented individuals in our public health sector, scientists, pandemic experts. Feels like everyone's playing an immunologist or a epidemiologist or a virologist on TV these days. It turns out science is really a thing, and being an expert in a field is really a thing as well. So shout out to everyone who's really working on getting us out of this. I think it's pretty important, the work they're doing. So a word of levity, brace yourselves. Data analysis is coming. All right, so starting off on the market. Let's give a quick showings update. I just updated these very recently. In fact, I think the next one actually goes through the 10th. So just looking at these guys, going back to the beginning of this year, we can see the climb. We were actually looking pretty strong until COVID kind of took hold mid-March. Looks like just about March 14th, 15th, 16th. We started to slide. You guys can see exactly how that looked. A little bit of a bumpy ride with Easter Passover, a little bump here with Mother's Day, but please do note we have gotten to all-time highs. We have reached new highs for the year. And again, I think this next one's actually going to show the most recent data point is actually even above the previous high. So here's Memorial Day, along with some of the other tragic events that took place that day. You can kind of see a little bit of a dip, but then sort of getting back as well. So this seems to kind of be standing alone out there. What I like to do is to contextualize things, to give a context and kind of show what's happening bigger picture. So to that end, what I've done is we're showing that same 2020 trend line, right? Looking pretty good, a little bit of a dip. and then kind of mostly back on track. But I've also plotted 2019 showings here, which I think is pretty fantastic if you ask me. It's just good to see sort of, relative to what, how were we looking last year? Well, again, you can see we were trending nicely ahead of 2019 levels until, the whole world changed and the pandemic took hold. So we obviously didn't see that dip in 2019 that we saw here in 2020. But what's interesting now is we've sort of gotten back on track. We're mirroring or mimicking that 2019 trend pretty closely, I would say. Again, I guess I was right. Every now and then I get something right. Let's see if I can see if we can zoom in just a hair. There we go. Pretty nifty. So check this out, guys. 610. If you actually notice, if you look real closely, this is technically above that previous peak. So, sometimes I do this. I don't mean to read too much into the tea leaves, but I will say it's encouraging that we're back on track for one. It's also encouraging that we've posted a new high. And, again, look at this, guys. In 2019, the highs for 2019 were, maybe I should zoom out. The highs for 2019 were in late April, right? Those were the highs for 2019. We never reached those numbers in terms of showings. What's so interesting now is, and I guess I won't zoom in again, but what's so interesting now is that we have actually reached new highs. This raises another question. So the question is, will we and when will we get back on track with 2019 trends? It looks like that's happened, but now the second question is, how much of this area below this 2019 curve, how much of this difference between gray and blue are we going to be able to make up later in this year? That's a big question on the minds of economists, pundits, I guess data nerds like myself and others. I think this is pretty interesting that we're already trending above last year. It's possible we see something like this in order to make up for that. It's also possible this is a fluke because of weather and we kind of, continue to mimic last year's trend. So just something to watch for here. So two things. Have we gotten back on track with last year? It seems like we have. And now, do we diverge from last year? Do we diverge from last year in order to make up some of this lost time or lost ground, maybe I should say? Okay, I spent way too much time on showings. Let's keep trucking forward. So as we've done, folks, we've sort of been thinking and talking about segmenting the market into three buckets. So you've got affordable, you've got luxury, and then you've just got the middle market ranges. So, if people think of these differently, maybe affordable's under 250 or 3. I know sometimes we say 3, some say under 2. Luxury might be, I don't know, 750K plus, maybe million plus if you want to really talk high-end luxury. And then middle market is sort of in between, say maybe 3 to 6 or so, 3 to 5.5, or even 3 to 6.5 or so. So just these middle market ranges. And, let's be thinking about what's impacting buyers in the affordable range. Well, a lot of them work leisure, hospitality, restaurant, or retail type jobs. And we know that those sectors were some of the hardest hit. Let's take a look. Non-farm payroll, April, hardest hit sector, leisure and hospitality. And, a lot of other research shows that, many, I don't think we can say the majority, but many first-time buyers do work in these roles, maybe these roles, surely maybe these roles. I mean, obviously there's first-time buyers across the board, but we know that a lot of younger buyers, tend to be in retail, things associated with that leisure and hospitality sector. So we know they're harder hit. Luxury, what's happening with our luxury buyers? Well, what about some of the swings we've seen in the stock market? Last I checked, sounds like we're doing another 1,500 point down day today, even though we've had some pretty substantial up days. And we definitely have made up for a lot of the losses, although we're obviously not all the way there. And no guarantees we'll get there. If today's any indication, perhaps we have some more concerns to work through. But those luxury buyers, nevertheless, are really impacted by the stock market and by some of those changes and swings or shifts that we see happening in those equity markets. So I know I've given this example in the past. Let's say you're a really fortunate individual, you're having a good year, and you're worth $3 million. Okay. Well, when the stock market was down by 20, 30%, let's say you've got most of that in the market, you might have just lost 600, 900K. maybe even $1 million, right? You lost a third of your wealth if it was in the stock market. Well, if I were one of those folks, first of all, I'd be feeling pretty crummy. But second of all, I'd really be reevaluating my decision to make a purchase. Now that it's coming back, and we always knew it would come back, just not at what speed. Obviously that's changing. Those dynamics are changing again. So I think early on, kind of right away, we saw these luxury buyers pulling back just because of those changes that we saw in stocks. There's this thing called the wealth effect, the perceived wealth effect. If I lose some wealth, I'm not so confident about spending and making large purchases. So that sort of leaves the middle market, right? Call these boring salaried professionals who are able to work from home, maybe some growing families and some new household formations there as well. I think I want to make one more note. We saw the non-farm payrolls in April. I want to also talk about the where the job losses hit in March. I know we've been talking about this. This does feel like old data by now. I couldn't find something similar for April or May, so I guess we're kind of stuck with this. But look where most of the losses occurred, you guys. The vast majority of them occurred in populations or among worker groups with a high school or GED or less education. Folks with a bachelor's, an associate's or a bachelor's and higher have not seen the same impact. Here's something interesting. Saw this from, I think this is Pew Research. I'm almost positive, although I don't see that. They do a great job. So the percent saying this has happened to them or someone in their household because of coronavirus. 28% say we've had a member of our household laid off or lost their job. 33% said we had someone in the household who had to take a pay cut. And then sort of all together, so we can kind of see how things break down from a racial standpoint, from an age or demographic standpoint. Again, guys, look at where your first-time buyers are going to be. Not all of them. Some are going to be here and some are going to be here and here, but a lot of them come from this range. And we can see that this age range was obviously harder hit in terms of job losses and pay cuts. We can see sort of by socioeconomic tritile, or sometimes we use quartiles or quintiles, but of this group of three. And then again, high school or less, we can see a disparate impact there as well. So just interesting things to kind of think through as we're considering who's been impacted by this more. First-time home buyers, we've looked at this a few times. Maybe our average is about 38% or so. Notice when the market kind of was in a challenged space and home prices sort of went on sale, we actually saw 50% of home buyers could be first-time buyers. So pretty interesting data point there. As prices have risen, we're actually seeing that 33%. So roughly 1 in 3 buyers are first-time buyers. Stands to reason then that buyers are getting a little bit older as they're a lesser share, perhaps they're aging. I've made the joke a few times, most buyers get about 12 months older each year. Me, I think I get about 18 months older each and every year. I don't know about you guys. So here we go. Back in the 90s and early aughts, median age of 32. So half of first-time buyers were over age 32. The other half were under age 32. Again, home prices went on sale 08, 09, and 2010. Actually, 30-year-olds was the median. 30 was the median age for first-time buyers. Prices rose. We got to 31. Prices kept rising. Now we got to 32 years old. And now we actually have seen a new high in this NAR data, at least at the national level, this median age of 33. Folks are having to wait another year or two or sometimes more in order to get the down payment saved that they want, whether they want to get PMI off or not. Obviously, there's lots of calculations there. And just to save for a down payment and to feel like you've got the liquid cash flow to deal with maintenance and taxes and everything else that kind of comes along with the responsibilities of home ownership. Here they are, folks, millennials living through their second once-in-a-generation economic collapse. I think they're mostly smiling, not always, but they're giving each other elbow bumps. Millennials waiting for the housing market to crash so they can buy their first home. We're kind of licking their chops there. We'll talk about this. We're not necessarily forecasting prices to soften. It's a possibility. I don't believe it's likely, but we'll talk more about that. Oh, you owned your own home with only one person in your household working a 9 to 5 job that doesn't spill over into your personal life and didn't require a bachelor degree. Please tell me more about how easy my generation has it. Please forgive my levity here. So this all leads us to a theory, you guys. If the top and bottom could be a little weaker, maybe the middle is kind of performing the best. So let's see if we're right. All right, right off the bat, guys, looking at change in showing activity by price point. Don't read too much into this. I'm going to show you guys bigger charts and more recently that show the same data, but again, more recent. I just want to show this to you because, well, as the as the top line sort of indicates, this is why we love data. This is why we do what we do here. And this is why we believe, in fact, we're almost certain that this provides so much value to you guys, to our industry partners, to the public, really anyone, to our media partners. So look at this, guys. Late March, here we have every single price point is down in terms of showings, right? Every price point is down to varying degrees, like we just talked about. Here's luxury, 800, well, I guess 800 and up, especially a million and up. That's where you saw the pullback in showing activity right away, right? Down 45% versus 20%, 24% in other price ranges. So everything down right away. And then we had this transition week where some up, some down, some up, some down, couple up, some down, couple up. So transition week. And then here's when things really got interesting. This is when we saw at least that first phase of a turnaround or recovery. Not saying we're out of the woods yet, not saying we're in the clear. I don't think anyone can say that with 100% confidence, but we did notice a pretty strong turnaround, at least so far, in that mid-April period. So everything up, right? Showings up across the board. And also notice a 93% increase in one of our luxury segments. Well, maybe that makes sense because those were so hard hit right away. Those were those were down so substantially right away that maybe it made sense that they came back the quickest. You'll almost notice this is the water level. This is the water. These are the mountains. Well, maybe these are the mountains and this is the reflection, right? It's sort of a reflection in the water. I think that analogy worked better in my head, but we're just going to go with it anyway. So everything down, some up, some down, everything up substantially, and then this isn't even our most recent week, but I'm just showing it as an example. After everything being up substantially 30, 50, almost 100%, well, now we're seeing more, historically consistent, more average gains, 10, 20%. Yes, some of our luxury range is still showing a pretty big gain. So one more time, everything down, some up, some down in transition, everything up, and now sort of getting back to, I don't know if I'd call it a normal, a sense of normal, but I heard someone say this is the new abnormal, kind of like that, the new abnormal. All right. So change in showing activity. This is our second to most recent. I've even got a more recent one for us today. Change in showing activity by price point. You can kind of see some of our more affordable segments down. Even some of our mid-market ranges were down, which is kind of interesting. Maybe you call this the first move-up market. For some, it's the second move-up market. For others, it's something they will never be able to achieve or obtain. Saw a little 1/10% gain there. The real big gain came in, I always struggle with what to call this, maybe our young luxury segment or entry-level luxury, or maybe the upper middle. I don't know. Everyone has a different name for it. So that's the segment that was kind of our big winner in showings. Luxury market down as well. And overall down about 12% from the prior week. So here's our most recent data, right? This goes through June 7th. So the first week of June compared to the last week of May. Nice when these dates kind of sync up perfectly. I like that. So here we see pretty notable gains, fairly solid gains in our affordable brackets, say, maybe under 250 or under 300. See some nice gains between, say, 17 and 19% there. Still gains, but a little bit less so as you get into our middle market or upper middle market ranges, excuse me. Interestingly, that was our only gainer the previous week, and this is our only loser this week. So sometimes, guys, sometimes it's like watching grass grow or watching paint dry. You don't always see real clear movements by the minute. or I guess paint dry, you can kind of see that by the hour. Grass growing, it'll probably take a couple days, depending on how much rain you get. Anyway, nice gain in million plus, 45% for some of our luxury buyers and million plus. Again, you can see a 50% increase if we go from just 60 to 90 showings, right? 60 plus 50% would be 60 plus 30. That would get you to 90. That would be a 50% gain, but hey, it's only from 30 more showings. So seems like a extreme percent change, but maybe not an extreme, raw number, not a big gain in terms of raw numbers. All right, so we've been talking about this a little bit over the last several weeks. We continue to hear that builders are having less showing traffic, but it seems to be a higher quality traffic. Perhaps think of it as a more motivated buyer. So the true qualified buyers are still there, still shopping, but the fringe buyers or the looky loons have sort of moved on. All right. So sticking with this latest data, looking still at overall showing activity by price point, we can see gains in most segments. As we saw, our only loser is this 600,000 to 800,000 range. Fairly notable gain in million plus. But you guys can see the bulk of our showing activity is in these price brackets, which makes sense because our median is sort of right about here. I think we're about 300, 305. So interesting breakdown there. Also, we've been talking about the share of overall showing activity. So this one's interesting, you guys. Notice how, here's a good example. Notice how we had decreases in market share for 3 to 4 and 4 to 5. Well, how could that be? We actually saw gains in overall showings for 3 to 4 and 4 to 5, right? We saw gains, but we actually saw declines in the share. Why? Even though these guys had gains, the gains weren't as large as they were in other segments. So even though they had gains in activity, they could still be losing in terms of their share of the overall pie. So their slice of the pizza may be growing, but it's not growing as fast as the overall pie. That makes me hungry, but I guess that's the best analogy that I've got off the top of my head. Pretty notable gain, a million plus, right? 1.6. So roughly 1.6 showings out of every 100 showings, or maybe I should say 16 out of every 1,000 showings are million plus versus nearly 1 in 4, 1 in 5, and 1 in 5, for more of our affordable segments. All right, we've been talking as well about the life cycle of a listing, and I want to keep thinking about that. So we have a listing is new and then it's active, right? A buyer gets a pre-approval letter and then they go to a showing and then hopefully they write an offer and that becomes a pending sale or an under contract. And then eventually the vast majority of those will become closed deals. So again, just thinking about, we try to get ahead of the market by monitoring some of these leading indicators. And sometimes the answers really are in front of us and we just don't realize it. So you want to, sort of start to predict or get a sense for what's going to happen with active listings. Well, look at new and how many of those I suppose are going off the market, but how many are coming on? You want to look at how many signed contracts might we have next month or the month after, or heck into, November or December. Well, look at showings for several months prior, right? As we see gains in showing activity, we tend to see gains in pendings, which of course, not all, but the vast majority translate into gains in closed sales. So, when people ask, oh my gosh, what do you think will happen with closings? Maybe the answer is as simple as, well, look at what's happening with pendings today. And that tends to give us at least a bit of an indication. It's never going to be 1-to-1, but it's sort of the best we got. All righty. Shifting gears to new listings. I know we've been looking at showings a lot. Let's take a peek at seller activity. This is our most recent weekly report. You'll find this on our Fast Stats page right on our website, mplsrealtor.com. Either click on Market News or scroll down to our Today in the Market section. We've got this year, 2020 in blue, and we've got last year, 2019 in gray. As you can see, we have been on a little bit of a downtrend, at least over the last week. I don't know if I can call 1 week a trend. Someone said to me, a friend of mine said to me, in his best Yoda voice. 1 week does not a trend make, young Skywalker. That also sounded better in my head, but we're going to keep moving nonetheless. So it's nice, guys. It's nice to see that we this low has sort of held, right? This has held water. We have not blown past that low, which is encouraging. It's not to say we won't. I hope we don't, but I cannot say that for certain. But again, we are still higher than these lows, and we actually did see a nice gain in seller activity, and then a little bit of a wobble. But that's not uncommon. Even last year, as we get into Mother's Day and Memorial Day, and I guess especially some of the recent tragedies surrounding Memorial Day, maybe that's reflected a little bit here. But this was down last year when we were up that same week this year. So sometimes we're off a little bit. Sometimes you'll just see some movement here. So that's on the seller side of things. Let's shift over to pendings on the buyer side of things. Okay, so this one has easily surpassed its highs from the pre-COVID era, right? Before this actually looks like Pi Day 3.14 marked that kind of break where we were on the growth trajectory, and then after COVID, obviously we had a pullback. So we have easily surpassed these levels from mid-March. Looks like we surpassed that early May, and then we've added on, right? We really saw nice gains here. So this tells me that buyers are, I don't know, should I say more motivated, or I guess buyers are more excited than sellers. Buyers are encouraged by, low rates. Some are encouraged by less traffic, less congestion in the marketplace, as some folks have obviously postponed transactions or sort of fallen out of the market, at least for now. A small share of those will be permanent fallouts, but the vast majority, most surveying and data shows, and surely our best guess is that the vast majority of those will come back, but not all. So look, guys, you can see how this really has mimicked the trend from last year. I don't think there's anything major to write home about. We can see from the decline this year, we definitely had a little bit of a gap, but we've been working pretty hard on closing that gap. Turns out there's a lot of other gaps in our society that need closing, but I'm talking much more about this gap today. And again, guys, look at how much, really in the last 3 weeks, look at how much we've mirrored that trend from last year. So I think that's a good thing, although obviously we'd like to see this actually even surpass last year in order to make up some of this lost ground. So that's pendings and listings on the weekly basis compared to last year. What if we compared new listings and pendings to the last 3 years? Ooh, not bad. Okay, so here we've got 2020 in black, and we've plotted this alongside 2019, 2018, and 2017. I could have done those in a better order, but oh well. So again, new listing activity, so seller activity for 2020 looking pretty good, sort of in maybe second place here, maybe second place. Looks like it actually in first place a little bit of the last 4 years until mid-March hit and the whole world changed. And then we saw those declines. Looks like sellers kind of put in their lows around mid-April, maybe April 14th or 15th or so. And then as we saw, we had this nice increase. So let me just go back, you guys. Here's that same increase. It really is mimicked. We had that nice increase, little bit down, up, and then more down. So nice increase, little bit down, more up, and then more down. So, the trends really are mimicked. This shows much more variation because it is a daily count, but we average up all those daily counts into a weekly, a rolling weekly average. So not only does it show more variation and more movement that may, have meaning to us and to you guys, it also goes a little bit further. So you guys will notice our weekly in our weekly report, that data only goes through that last week of May. You'll notice here that we actually go through, I think it's June 6th or 7th. Sorry, maybe 7th or 8th. We can't quite go up through yesterday, guys, because agents have, oh shoot, I should remember this. Can't remember if it's a 24 or 48 hour period to enter some of those status changes. I think it's 48 hours. I know someone will correct me. Maybe, let's see, Amy or Jeff or I'm sure someone will correct me on that. So, this downturn, or I should say, maybe this U shape here, guys. This isn't unique. This was the same trend we've seen in the prior 3 years. So this is not a unique trend to have this dip, and I think that's also also meaningful from just the plain weekly chart. So again, we'll ask the question: can we sustain this uptrend? We think we can. We hope we will, but obviously time will tell. We can't say that for certain. Pending sales chart has been a little bit volatile lately, kind of some jerky movements up and down. Let's look at the bigger picture. Again, on the sales side, so on the demand side of our equation, pending sales, look at this. We were really performing pretty well in terms of buyer activity and signed contracts for several weeks there, maybe almost as much as a month, maybe minus a few rolling weekly averages here. Buyer activity this year was at the front of the pack, right, in first place compared to the last 4 years. So, for that reason, among others, we felt that this year was off to a pretty strong start, and we think, we believe that bodes pretty well for getting out of this mess that we're in. So here we go, mid-March, 3.14, Pi Day. Things really seem to change with the school closure and the shelter-in-place order from the governor, the executive order. So we saw the result of that. You couldn't make this up, you guys. Almost smack dab on the money, March 15th, we started to decline. And then pretty much right on the money, April 15th, we kind of hit that bottom. So it really was a month of declines, at least so far. Talk about second waves and all this stuff. Again, I'm not an epidemiologist or an immunologist, so I'll leave that to the experts and to our scientists. But I will say we've had some nice recovery since then. It's possible we go back to these levels, but I don't think we will. So lately, again, we mentioned this volatility, a little bit of a jerky movement here. But again, this is reflected in the prior year. So this doesn't seem new or unique to me. This is new and unique, but some of this volatility around, holidays, and I know we saw a little bit around Mother's Day and a little bit around Memorial Day. And then look, we've sort of flattened out as we have in past years. In fact, I could even argue we're flattening out while past years have still been declining. So kind of some interesting data here. And again, it seems like this buyer trend is, I don't know how I should say it, much more intact, or maybe more enthusiastic, or, it appears to be more in line with past years than our seller trend. So just a note there. And again, I'll ask the question, can we sustain this uptrend? I think we can. We can't say that for certain, so time will tell. So let's take a peek at changes in seller activity or new listings broken down by price bracket. So this is week ended 5/31 versus week ended 6/7. So that last week of May into this first week of June. See a pretty notable gain in seller activity for this first luxury segment, or entry-level luxury. Again, I always struggle with what to call that. Slight gain in this mid-market, and a loss in seller activity for million plus. Or in our true luxury segment, we actually saw a pullback, not so much in that 750 up to $1 million. So overall, we saw 10% more new listings from this week from the last week into the most recent week. But again, we can see some pretty extreme variation based on price point. Let me just say, it's nice to see, 9 to 10% gains in some of these more affordable ranges. Again, because so much of our volume is here, these two ranges tend to dictate or exert more influence, I should say, on the overall or the total number. So these are bigger planets, therefore they have more gravitational pull. There you go. Yeah, we had a physics lesson as well, or astronomy. How do you like that, folks? You really get your money's worth here. All right, change in pending sales by price point. Here we see a pullback in luxury on the buyer side. Nice gain in maybe upper affordable or lower mid-market, or this 250 to 350 range. Nice gain in 5 to 750. So this move-up market. A little bit of a pullback in 750 to $1 million, and then no movement in million plus, for overall a 5.5% bump in pendings. All right. How about the same week, well, roughly the same week last year, so that the week ended 6/8 of 2019 versus the same week this year, which happened to end 6/6 of 2020. So just based on when the year, starts and leap years and things like that, can just throw this off just a little bit. So change in new listings by price range for this week last year versus the current week this year. Interesting. Here we have I guess, a little bit of a normal curve here, where we see pretty notable declines in seller activity especially in our most affordable price ranges. So we've talked about this in the past, guys. I won't nerd out on it much more, but a 50% pullback in seller activity under 120,000. Well, I guess I'm not surprised by that. These tend to be much smaller properties, sometimes one bedroom condos, or less. And so you won't see a lot of new listings here. And, if you're an owner who owns this and, you really are budget constrained, you probably wouldn't sell it because you probably like your payments on it, or maybe it's paid for. And that you probably couldn't get that again anywhere else for that price at those payments. So I think folks are hanging on to, even in this segment, I know folks are hanging on to that a little bit. But remember, folks are hunkering down too. Folks who might own in this segment who may have experienced a job loss or a reduction in household income from a pay cut, like we saw with that Pew Research. Maybe you wouldn't be as likely to list your home because you're not ready to move up. Even if you wanted a similar house of similar square footage in a similar area, you're probably going to pay a lot more. So if you're making payments on a loan that you borrowed, say 180 grand for to buy a $200,000 house, if you want that same house, well, a similar house of similar square footage, similar bed, bath, in that neighborhood or a similar neighborhood, well, that's probably going to cost you $250, which means you'll have to borrow $230, which means your payments will obviously be higher. So just some thoughts there. I said I wouldn't nerd out on that, and there I went and geeked out on it. Only segment with a gain over the same week last year is $500,000 up to $750,000. Another 40% pullback in million plus for overall a 30% decline in new listings. So here again, pending sales only see a 7 or 8% decline in signed contracts or accepted offers. Some interesting data points here. So 120 to 150, 5% more signed contracts on those listings than last year. And here we see, more notable gains, 8% bump in signed contracts for, say, a $375,000 home or a 4.25 or 450. So in this 350 up to $500,000 range, we saw that nice 8% bump in accepted offers, right, on the demand side, but a 20% bump compared to the same week last year in that 5 to 750 range. All right, let's think about monthly change. I know sometimes going week to week, whether it's week to week this year or week over week last year, sometimes we don't see a ton. So it's nice to just look at the month. I know what you're thinking. This is old data, and it is, but let's just look at the trend from March. Here we really have that normal curve where we see, declines, declines in the affordable segments. I guess one decline in the luxury segment, not our extreme luxury bracket, and then we have gains in the middle, and that's this middle market theory that we've sort of been discussing. So, let's call it 200 to, 200 up to 550 or 200 up to 600. Really was where we saw the gains in new listings. Some of that's builders, some of that's sellers. It's kind of a mix. So that's March. Still on March. That was March seller activity. Now we're on March buyer activity. So here again, you guys, we see a pretty similar trend where we see declines on the affordable side. Here we do see a pretty notable decline on the far luxury side, followed by, gains or growth in the middle. So here again, maybe we'll exclude 250 because that wasn't a huge gain, but especially 250 up to 5, right? So here again, you've got your 300s, your 325s, your 350 and 375s, where you see a lot of gains, a lot of growth in buyer activity for March. Before we pivot to April, just a little bit of a warning: viewer discretion is advised. April, new listings down about 21% across the board. But here again, right, we see a very similar trend. The largest gains came in affordable. We also saw some large gains in, sorry, did I just say gains? We saw large declines in affordable, large declines in luxury, and just a 7% decrease in new listings for homes priced between 350 and 500,000. Not a large decline there. I guess you could call this the best of a bad bunch, so to speak. And then, even here, you guys note these. I mean, I suppose we could exclude that one, but note these other sort of mid-market ranges that, didn't perform too poorly, down 20% versus down 40 or more. So again, we have a little bit of a middle market dynamic going on here. So that's seller activity. Oops, forgot I pointed out those mid-market ranges, the best of a bad bunch. And I want to also point out, I know we noted this the last couple of times, but look at our volume, guys. We saw the most dramatic declines here and here. Well, that was from 80 fewer, right? 80. This, call it 140 down to, 80, what is that? 60 fewer. And that made up a 45% decline. So here, this 7% decline, a 7% decline, but that's from, 100 fewer listings. So it's a less decline, but it's already more. So just know that some of the percent change can be dramatic, and sometimes it's useful to look at the numbers. And, I know we joked about gravitational pull, but look at where the bulk of the activity is, right? This is sort of the waistband. These are the Jupiters and Saturns, right? These are Pluto's not even a planet anymore. I caught myself. These are the smaller planets or asteroids that just don't account for a ton of volume. This is where so much of our gravity is, in these middle market ranges. All right, so we're thinking about these mid-market ranges as our best performers. Oops, I skipped something, guys. We went from, I pivoted too fast from seller activity to buyer activity. So taking a look at pendings, again, we see big declines in affordable. I guess not that large of a decline on the demand side for luxury, and then perfectly even from 3/4 of a mil up to a mil. And I find that pretty interesting. So again, not to beat the dead horse, but our mid-market ranges are performing the least poorly. This one just fascinates me, right? 88 pendings last year, 88 pendings this year. That is a 0% change. What are the odds of that? Maybe about 1 in 88. No, they got to be better than that. You can see some of the volume, small volume here, pretty small volume here, obviously large volume here in our, say, 200 to 500 ranges, even 250, maybe up to 450. Okay, how about, I got a treat for you guys today. Let's take a sneak peek at new listings by price range for May. I want to say something on the record. These are preliminary figures. We do not have official May numbers run yet. So these are preliminary. You guys will also see, you can literally reproduce all this in InfoSparks. So you'll notice we have May numbers in InfoSparks as well. Just know that those are also preliminary until we have our official numbers. So here we actually see the largest declines in seller activity in affordable. And here we have less of a middle market dynamic, and actually luxury in terms of new listings seems to be performing well. So we did not see large declines in new listings in some of our luxury brackets. How about on the buyer side? So I guess it's not quite as pretty, but you can kind of see a middle market dynamic here as well, where this mid-range, 350 up to 450 or 350 up to 500, only down 2.5% on contract. So not a large decline here. Again, there's lots of salaried professionals who are able to work from home here. So you can kind of see that dynamic at play. A little bit of interesting dynamics, in this segment versus these two. I won't read into it too much, but just know that, this is kind of how the picture looks. So that's on the pending side. And now I do not have as much time as I wanted because I geeked out with you guys way too much. But let's just pop in really quick. Let's just pop into, well, first things first, let's look at our market reports, just for anyone watching who is not familiar, or I suppose anyone watching the recording who may not be familiar. I mentioned our COVID resource page. You'll see the link there. We also have our Twin Cities Recovery and Rebuilding link there. A couple options. I like to use this option because it's just right there and it's just very scrollable and accessible. But just know that you've got our reports here under market data as well. I'll just give one of these a click. Well, I've already got it open. So clicking on local market updates will open up our local market updates. Big shocker there. We've got our monthly, we've got our foreclosure, even our annual report. So everything's here, you guys. Let me just click on the weekly, just in case we have any crisis in confidence. There you have it, folks, right? The exact new listing trend that I just showed you guys, and the exact pending sales trend that I just showed you guys. I just took a screen grab and took it right out of our weekly report there. So you too can be a data expert. In fact, I want you guys to be. So local market updates, I know you guys will be spending the bulk of your time here. So I just want to show you, I'll click on Hennepin County. Maybe I'll just click on Plymouth. I'll pick on Plymouth today. So like I said, we're still on April. In the next couple of weeks, we will transition to May as we run those numbers, those official numbers. So Plymouth, all right, sellers down about 16%, but over the last 12 months, seller activity has actually been up 0.5%. Closed deals down 4%, no surprise. These were for contracts entered into perhaps in March, where we saw some of that impact. Although overall demand is rising over the last 12 months. So I won't do all of this, but just know that that's here for you guys, right? Maple Grove, just kind of looking at some differences here. We can pivot down to maybe some of our faster growing communities. Savage and Shakopee are very rapidly growing. I kind of see some of the numbers here. So there's just so much we can learn here, guys. This is interesting. Over 100% of original list price for homes in Shakopee, right? Pretty strong demand, a pretty notable imbalance between supply and demand at just 2.1 months of supply. Very much a seller's market. So sellers are yielding or realizing 0.2% more than their original list price. At this time last year, maybe I should say last April, they were only, I put only in air quotes, only getting 100%. So just know that that's all here for you guys. Monthly report is nice too. Our HSO, the housing supply overview, definitely has some interesting data points. I think you guys are going to be spending most of your time here in the local market update. So I'll spend most of my time there. Let me also just pivot in 5 minutes, and I want to leave 5 minutes open for questions. Just in my last couple minutes here, I want to show you guys from the North Star page, right here on the home tab. Let me zoom in a couple times. Right here on the home tab, you guys will see InfoSparks right there. You'll also see InfoSparks down there. And let's go to a listing page, and you will also see InfoSparks. Let's do St. Louis Park today. You will also see InfoSparks right here. Hey, not bad. I like the exposed wood beams. A little dated on the kitchen. All right, anyway, sorry, you guys. I shouldn't do that. Okay, so InfoSparks, let's just pop in, and let me make this a little bit bigger. Okay, I think that's the best we're going to do. So just taking a look, you guys, new listings. We can definitely see a little bit of a change at the end of our trend line. We can see something happened, and we know what happened. So let's go monthly here. I know that's rolling 12-month. If we actually look at the monthly, right here, we can see kind of during the bubble, we saw a lot of supply coming on the market. Then that was kind of on the decline. And then we saw March 2010 and April 2010. You guys remember that tax credit period? It's a little crazy to think that was 10 years ago, that tax credit period, March and April 2010. So we kind of see this pie in the sky a little bit. Then we saw a recovery. It looks like for May, we were actually on the rise, a little bit higher last year. And then the world changed. And now we kind of see the market seems to be a little bit capped. As we showed, it looks like May was the peak for new listings. Here, May was the peak again. Last year, May was the peak again. Well, folks, here we are at May. It looks like so far March was our peak because half of that month was pre-COVID. And remember, a lot of sellers come online at the beginning of the month. Yes. Okay, so that's new listings. Let's look at pendings. What is happening on my Zoom? Maybe we have a question. No, maybe not. Okay. So here on the pending side, you guys, why is it still beeping at me? All right, we're just going to let that be. So on the pending side, you guys, well, now I can't quite see everything I want to see. So let's just do this. All right. So on the pending side here, again, we can kind of see things seem a little bit capped here in terms of offers, signed contracts on the pending side. May was our peak in 17, May was our peak in 18, May was our peak in 2019, and here we are at May. It's possible May won't be our peak. It's possible we'll see increases into June, possibly even into July, again, depending on how much of that lost ground we make up. So just kind of be watching for that. All right, let's dive into maybe a couple more advanced use cases just to show you guys how we can use the tool to analyze the market. Instead of filtering down to single family or condo or townhome, I want to break out these different submarkets, or I want to break out my variables. All right, so here I've got single family, condo, townhome broken out. Instead of trend line, I want to switch to bar charts. This just, I think, has more meaning for me. I'm able to see trends and I'm able to see the picture just a little more clearly and a little more quickly. So, and you know what, guys, pardon me, let me start with new listings. I always like to start with seller activity, then go to buyer activity. So here we saw a 24% pullback in seller activity for single family. And by the way, this is just for May. And you'll note this is monthly. So not our rolling 12 month, not year to date, just the month of May. 24% pullbacks for single fam. Interestingly, even less of a pullback, 23% pullback for condo. I know last month, by far the most dramatic pullbacks on both the seller side and the buyer side came by way of condos for fairly obvious reasons. And then townhomes actually are best performer, or our least bad performer, down just 19%. Let's now go to contracts. Single family contracts down about 9.5% for May, about 38% for condos in May, and then 18 or 19% for townhomes for May. So that's pending sales. How about days on market? Are things taking longer to sell, less time? Single family still taking less time, right? Days on market down 6%. So, condo buyers are taking a little bit more time. Yeah, we can see that some of those listings are remaining on the market. Again, some of the health concerns around, higher density buildings. We understand the concern. I don't think downtown living is dead. In fact, I think just the opposite. I think all the surveys show that everyone from millennials to baby boomers, they all want walkable communities where they can walk to get a wine or a beer or see a play or, get a bite to eat. And so I do not believe that this will be a permanent change. I really don't. And then townhomes, market times also up just a little bit. Sales prices for May, again, this is a pretty interesting one. Single family up about 1.5%. Townhomes up about 2.25%. We actually did see prices soften a little bit for condos. So median sales price last May was 190. This May it was 185. So not a huge change, but a change nonetheless. Okay, guys, the last thing I want to do, I want to just talk price ranges. I know I'm moving quickly, so just so you guys see, I click on custom, not the breakout that we clicked on here, but custom. So from here, I'm going to do, and let me just do pretty broad ranges, 0 to 250, 250 up to 499, 500 up to 999, and then $1 million or more. Done. All right, now we've got our custom price ranges right there. Now I'm going to click breakout. So I want to break those out. I'm just going to turn off all. Doesn't make a ton of sense to look at price ranges. Doesn't make a ton of sense to look at sold price by price range, but you guys can see some of the differences in seller activity by price point, pending sales activity, so signed contracts by price point. Again, biggest decline in affordable, followed by the next biggest decline in luxury, our sort of middle market segments. I know I don't quite call all of this middle market, but these tend to be performing the best. Days on market, wow, almost a 200% increase in market times for million plus, from 68 days to nearly 200 days. Well, let's remember, we're only talking about 44 sales, so not a lot of activity, but definitely some. And we also see increases here in this affordable segment. Again, homes are still selling more quickly in these middle market ranges. And with that, I see we are at 2:58, and I want to pause to see if we have any questions or feedback or thoughts.
I'm not seeing anything in the chat or in the Q&A. We can give it another minute. I know we have people joining because we're going to extend this one a little bit for the vote.
Yes, indeed. All right. Well, maybe I'll be greedy with our final minute here, and let's just do one more for you guys. Let's just break out new construction real quick. New construction, new listings down just 0.3%, right? But it's not even 1,000 new listings. Here in previously owned, down 26%, and that's 6,300 new listings. So better performance in new construction, but it's still a pretty small share of the market. And let me just do pendings here. New construction flat, obviously down 14% for previously owned. And let's look at market times. So here again, faster on new construction, flat on previously owned. So I find that pretty interesting. Let's just look at the market balance real quick. I think new construction should be about 5 to 6 months. Ooh, got that one right. Thank God. And let's let our system think about previously owned. So a little over 5 months for new construction, 5 to 6 months. That means that segment is balanced. 1.7 months for previously owned. This is where so much of the demand is and not a ton of the supply. So we can really see kind of what's happening in that segment. And like I said, more affordable prices in previously owned, obviously. So you see just a tighter market there versus our new construction market.
See, David, we just got a question asking, when will we see mortgage payment delays come to market?
Yes, mortgage payment delays. You know, it's an interesting question. I've got a few, let's see. Yeah, so I've got a few visuals that kind of show, this really wasn't as dramatic as we thought. And oops, I think that's the wrong one. This is actually pretty poor quality, and I apologize for that. But and I suppose this is rent as well. But really, a lot of that just wasn't as bad as some people thought. But yes, eventually, yeah, this will come. Depending on how quickly, some of the furloughed folks and some of the laid off folks kind of come back into the market, I think that's going to really be the big impact. I think apartments.com and others, including NAR, have done some research on exactly that, and they've asked the question: if you were to lose jobs, or you lose your job or lose your income for X amount of time, how many months could you continue to pay your rent or your mortgage? And it was actually a higher percentage, obviously fewer on the rent side than on the ownership side. But they have asked that question. And, I think a lot said 2, 3, even 4 months. There was even a good share of homeowners that said up to 6 months or more. So I don't think we're quite there yet. But I definitely share Mary's concerns that, it's something that we are watching. And I think we ought to continue to watch. We see a lot of indicators kind of coming back. We see consumer sentiment, a little bit of a bump there. And we see mortgage applications pretty much back on track with where they were. Gasoline consumption kind of coming back. How about TSA checkpoints, kind of coming back a little bit. So even hotel occupancy, we see a lot of these sectors coming back. So I would think that would bode well moving forward in terms of forbearances and that kind of thing. But yeah, it's definitely going to have an impact. I don't think it'll be as dramatic as many feared, but it's something that we're watching.
All right. I'm not seeing any more questions coming through, so.
All right. Well, I want to say thank you again to our wonderful sponsors, Bell Bank Mortgage, North Star MLS, and Royal Credit Union, as well as Supra. Also want to say thanks to all of you for joining us. As many of you know, we do provide a recording to our webinars on our COVID-19 page, right on the mplsrealtor.com website. So we encourage you guys to join us again next week. I also want to give a shout out to my wonderful colleague, Eric Myers. He does a great job, really working hard to make his webinar informative and timely, and he's Mondays at 1 p.m. It's called Gab with Your Gad, which we absolutely love. Clever name there. So please do join him Mondays at 1. I think you guys will really get a kick out of it.